You're probably sick of hearing it, folks. But financial freedom is just the beginning, right? There's actually 5 that I track, and I'm going to add on to the 3 because you mentioned 3 that I track. There's 2 more that are really integral to the life that you try to live. And by the way, that's why Clinton and I are sitting here in basically t-shirts, in our recording studios, because we're not punching the clock every day anymore. So step 1 is you do have to hit that financial freedom, and that's simply where you're not trading time for money. That can give you time freedom if you do it right. Clint mentioned that if you have replaced your income, but you're still the one, you may be punching your own clock, solopreneur style, that's not quite the same. But, when you're not trading your time for money, that is when you start to achieve time freedom. When you start to achieve time freedom, you start to achieve geographical freedom. Okay, maybe the business isn't going to miss me if I leave for a week or 2 or 3. Or even if all you have to do is have a laptop and a cell phone and open it up once a day in Austria, wherever you are. Okay, that's geographical freedom. You can run your enterprise from wherever you are in the world. That's a lifestyle design topic.
Younger people, unfortunately, are not able to buy houses the same way they did before. They're renting. When you buy a house, you've got an attic, a garage, a basement. When you're renting, you're typically renting based upon the square footage that you're getting. So instead of a 2-bedroom condo for $1,800 a month, they'll rent a 1-bedroom for $1,300 and then get a storage unit as an extension of the closet, extension of the garage. They still have stuff, but it's lifestyle things. It's bikes, it's kayaks, snowboards, mountain equipment, waders, fishing rods, that kind of stuff. And they're also storing winter clothes. So because of that, these are expensive, important items that they are accessing a lot more. They're in and out of the property once or twice a month, if not once or twice a week. So that consumer has really changed in that landscape. And because of that, if you are doing storage these days, it needs to be several things: safe, secure, well-lit, easy access, centrally located, and it needs to be climate controlled. They need to be able to show up at 6 a.m. on a Saturday, scan a QR code or use a touchscreen kiosk, get into the building, get their stuff, and head off to the mountains to go snowboarding, right? So that's the shift that we're seeing.
You're listening to the Real Estate Runway podcast, powered by Quattro Capital, where we're all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, Chad, the investment maverick.
All right. Real Estate Runway family, welcome to another episode of the Real Estate Runway podcast. I'm your host, Chad Sutton, and I am here today with Clint Harris with Nomad Capital, one of the general partners. So excited to talk about what they're doing and their unique strategy in the self-storage space today. But before we do, folks, reminder, if you get any value out of this show or anything we produce here at Quattro Capital or Real Estate Runway, just interact with it, like it, share it, subscribe it, pay it forward, because it's the only way someone like you who needs to hear it will hear it. Okay. Now, without further ado, let's get right onto the show. Clint, welcome to the show. I see you're in studio. We got matching mics. We're ready to go today, brother.
Yeah, thanks, man. I'm excited to be here. I really appreciate the invite.
Yeah. So we were just talking about your story a little bit, and you've had quite the journey, coming from medical sales and rolling all the way through to where you're a general partner of Nomad. Walk us through it. Tell us about your journey, what you learned about passive income, and ultimately, I'd love to get to what y'all are doing today, because it is unique.
Yeah, man. Excited to unpack it. So I'm Clint Harris, general partner with Nomad Capital, married, 2 little boys, 4 and 1, live in Wilmington, North Carolina, specifically Carolina Beach, so down at the beach. My background is that coming out of college, I got into medical sales. I was implanting pacemakers and defibrillators, and I had a 16-year career working in cardiology. So I was in Columbia, South Carolina, built up a small portfolio of single-family properties. So medical sales is a young man's game. It kind of grinds you down. You're on call, working nights, working weekends. You can imagine heart problems are not 9 to 5, Monday through Friday. So getting called 2 hours away at 3 in the morning and in a very busy territory doing 3 to 5 surgeries a day. So I kind of always knew that I loved my job. I was blessed to be pretty good at my job, but one day I needed an off-ramp for that. And I chose real estate as that pathway. My first house was a duplex when I was like 25, I think, and I was house hacking before I knew what that term meant. And then we started buying properties in the 2008 crash. I'm 41, so like 2010 to 13 My girlfriend, later wife, we bought like 9 single family homes, accidentally bird a couple of them. Again, we had no idea what we're doing. This is before the podcast and the Facebook groups. I was listening to books on real estate on CDs that I rented from the library. So fast forward, and I took a promotion in 2017. We moved to Wilmington, North Carolina, which opened up the market in an area where Airbnb was an option at the beach. So I remembered the lesson from that first house. I also had figured out by then that single family homes is a very slow way to get ahead. So started listening to podcasts and educating myself. We bought a duplex 2 blocks off the water in Carolina Beach. We lived in one half that was a 3-bed, 2-bath. We turned the other 3-bed, 2-bath into an Airbnb. We did 57 grand that first summer. And I was like, oh, this is real money. And I was still working and doing surgery during that time, growing a territory. So we didn't have a mortgage. We were getting paid to live 2 blocks off the beach. It was incredible. So then we arbitraged a quadplex. I didn't have the money to buy something, so we figured out Airbnb arbitrage, and we rented a quadplex from someone as a long-term lease. And with his permission, we converted all 4 units to Airbnbs, and we rented those out. So after paying him and the cleaning fees and everything else, we net around $54,000 a year off of that. So we didn't have a mortgage. We're getting paid on top. I've got a good job. So after that, we went and bought a quadplex, then another quadplex, bought that arbitrage quadplex, and then built a house and moved out and rented the other unit. So 14 Airbnb properties, operating really well. But the problem was, even though I replaced my income, this is where I was very foolish. I replaced my income, and I hit a level of financial independence, but I was still tied to my phone. I was managing these properties, and it did not come with location or time independence. And I was like, man, I couldn't find another property management company that said that they could hit the same numbers that we were hitting, because nobody will mind your business the way that you mind your business. So that started a 2-year journey, along with some operating partners. We built a property management company from the ground up. So currently it manages my 14 listings and another 75 listings. So I get mine managed for cost. I'm completely hands off at this point. 2 years of really hard work, struggling to build that out, until I read the book Who Not How by Dan Sullivan, and realized that I didn't know how to do all these million little things that were a challenge for an entrepreneur. I needed to know who I had that would be a better fit for that. I actually stepped back from the company. I let my operating partner and one of our managers step in, and the company thrived. It did way better than when I was in charge. So the lesson there was like, I can operate, but I'm not a great operator. The smartest thing I did was get out of the way and let people that are better at their job than I was at their job take over. So now I have a meeting maybe once every 2 months just to decide where we're going to spend some marketing dollars, and then get annual distribution. So obviously I took a pay cut from that by stepping back. And this is where a pivotal moment in my life happened. I was like, okay, like, we built this up. This is great, but it's a lot of work. It's really busy during the summer. You're locked in. You got to be in one spot. That's not the life I'm trying to create. And I realized that we're all after financial freedom. It's a buzzword. It's all over your Facebook feed, but that's not really what we want, right? What we really want is financial, time, and location independence, because those 3 things together create an independence of purpose. And that's where you're going where you want, when you want, doing what you want, and you get to choose what your life looks like and how you engage with your community, or raise your kids, or spend time with the people that you care about. So I again looked at my portfolio and I was like, man, I did this all wrong. So I started the aggressive pursuit of the most passive investment strategies that I could find. The way that I did that was I roadmapped it by talking to the older, more successful real estate investors around. And ultimately, when I talked to those people that were living the life that I wanted, the guys that are going on the 2-month fishing trip and, backpacking the world, for them, it was mobile home parks, which I had no interest in. I was already burned out on tenants because my Airbnbs have 8 to 10 tenants a month per unit. It was hard money lending and note lending. And I didn't have the $1 million needed to get started with that. Or it was self-storage. I was like, self-storage. Okay, let me get this straight. There's no tenants living in the units. There's no bathrooms. There's no kitchens. And you're renting someone a box of air. I can get into that. So I started pursuing that. I'd been going to the local real estate networking groups, and I met my partners there, partners of Eric and Levi Hemingway. It's a father and son team, and they were doing hotels in my market in Carolina Beach. So we had some collaboration there. I was helping them with some of the short-term rental metrics and things like that. And eventually, fast forward 2 years, we bought a Kmart building together. Now I was still in medical sales. They came to me and were like, "Hey, we're going to do this project. You've talked about wanting to raise money and wanting to invest with us. Let's do it." So we put a joint venture together. I raised the money. I put money in, and I raised money from a group of cardiologists that I worked with and were buddies with. So we bought this Kmart. We converted it to a climate-controlled self-storage facility. We bought the building for like 1.5 million. We put 2.5 into it, so we're into it for 4, and it appraised for 9.1. I was like, "Oh, this is okay. This is the path forward." And the reality is, that was the same thing I was doing with little tiny Airbnb quadplexes. Adaptive reuse. I was buying these nasty little quadplexes with long-term tenants that had been chain smoking in the property. I was renovating and converting that property to a different asset class, to Airbnb. It was 3.5 to 4xing the gross potential rental income, which creates massive value that you can tap into and recapitalize by refinance if you want to, or just let it cash flow. So it immediately jumped out at me of like, that's what these guys are doing with this. They'd already done a few small warehouses before then. So I'll cap it off with this because I'm rambling here, but the end result is in the end of 2021, we started syndicating. We founded Nomad Capital. I'm one of the general partners. And since then, we've bought and converted to climate-controlled storage 2 Kmarts, 3 warehouses, 2 textile mills, a grocery store, and a soda bottling facility. We've got 2 more projects under construction right now. We have 3 more under contract, not including the ones under contract or construction. We're sitting at 150 million in assets under management, and we've never sold anything. I'm happy to unpack that, but I'll stop there and just we can catch up.
Yeah, there's plenty to unpack there. So let's walk through it a little bit. And just I got to give a couple of things that you kind of breeze through a little bit of credit. You know, one of them is when you mentioned the entrepreneurial realization of who, not how, right? And by the way, if you haven't read it, this is probably the 437th time I've said that book on this show. Who, Not How, Dan Sullivan, amazing book, mindset shift. Changes you from being the guy trying to do everything and figure out how you're going to get it all done to figuring out who can help you get it done, who's the best player to get it done and do a better job than you will. And the interesting thing is there's kind of 3 levels of this in my mind, right? A lot of us start as really good doers, right? And then you get to a point where you just can't do anymore because we all have the same 168 hours in a week and you got to sleep. And, you know, it's only sustainable to burn 150 hours for so long, right? And so most of us, if you're smart, and if you don't want to die in that segment, you think about, okay, well, how can I start to build systems and then bring in other people who can replace me in things that I'm doing? And that's the first level, like getting good at building systems and allowing others to do things you've laid out. That's like the first step to really becoming a growth entrepreneur. And then what Clint was talking about here is, okay, now I may not even know how to build the system that I need for everything I need in this property management business, for example. Then you start building people. And when you start building people, that is the mecca, and that is where you really start to scale. That's where you have the ability to become the size of a General Electric or something like that. Okay, maybe not go public, but you get my point. You can start to bring in the best and brightest in the industry to really solve the problems and say, hey, I need you to go do this. I don't know what it looks like. Go figure it out. And then you have the right champions to go do it. That's how, you know, someone like Clint can build a property management company when he probably doesn't know that much about property management, you know, to begin with. And what he did is they're probably 10x better now, right? Given that you've put aces in their places. Am I right in that?
Yeah, we like to say right person, right seat, right?
Yeah.
And like I'm not the best the best property manager in the world or in the state or on my island or even in my company. I'm like the fourth best person in my company. And I love that. That means I've identified people that are better at it than I am. And we put them in the right place. So,
Yeah.
you know, I use the term, I first read that book, it was years ago, right when I needed it while I was building that company.
Yeah.
But I say the words, who, not how, at least 3 to 5 times a week. I've already used them this morning in a discussion. It's like, this feels like a who, not how situation.
Oh, yeah.
I don't know how to do this, but I think I know who I can find that does know how. So yeah, it's an important mindset shift.
If we made it a drinking game on this show, there wouldn't be a sober person in this audience. So, you know, every time I say who, not how, or Dan Sullivan, take a shot. So anyway, I digress. But the second thing I really wanted to gloss into before we go focus on the strategy, because I really love the strategy and I'm so excited to spend the rest of the show on that. So let me mind our time here. But you mentioned the 3 freedoms, right? And so again, building on that, financial freedom is something that we hear everywhere. It has really been what's guru-tized and social media-tized and all that stuff. So it is a buzzword. You're probably sick of hearing it, folks. But financial freedom is just the beginning, right? There's actually 5 that I track, and I'm going to add on to the 3 because you mentioned 3 that I track. There's 2 more that are really integral to the life that you try to live. And by the way, that's why Clint and I are sitting here in basically t-shirts, in our recording studios, because we're not punching the clock every day anymore.
That's right.
So step 1 is you do have to hit that financial freedom, and that's simply where you're not trading time for money. That can give you time freedom if you do it right. Clint mentioned that if you have replaced your income, but you're still the one, you may be punching your own clock, solopreneur style. That's not quite the same. But, when you're not trading your time for money, that is when you start to achieve time freedom. When you start to achieve time freedom, you start to achieve geographical freedom. Okay, maybe the business isn't going to miss me if I leave for a week or 2 or 3. Or even if all you have to do is have a laptop and a cell phone and open it up once a day in Austria, wherever you are. Okay, that's geographical freedom. You can run your enterprise from wherever you are in the world. That's a lifestyle design topic. Beyond that, once you've achieved those 3 freedoms, 2 other things happen. You start to have what's called freedom of relationship, which is, think about it. Like when you're punching a clock and you're an employee in a company, 75% of your time, conservatively, is spent with people you're kind of forced to be around. It's either your family, who I hopefully like to be around, or it's your coworkers, right? Or people at work events or whatever you're forced to be at. When you don't have that anymore, you get to choose the relationships you pursue. And when you choose the relationships you pursue and you have the other 3, which are financial, time, geographical, and relationship, you also get to freedom of passion. And that's really where you spend your time on whatever the hell it is you want. Some people turn to charity. Some people turn to continued building. And maybe it's a new venture, but you get to spend time on your passion. So I had to walk through that. One of my partners and mentors, bestowed the 5 of those on me. And so I had to come back and just stack on yours a little bit.
I love that. I'm going to carry that away from this. This is one of the reasons I love doing podcasts is I always learn something. So yeah, that was great. I'll be thinking about that a lot later.
Yeah. Cross-pollination. So let's spend the last, 10 or 15 minutes. Really want to dive into what you're doing there. And I think you were very astute in how you said it, adaptive reuse, right? And so a lot of us who, like, for example, we've been doing apartments since before they were cool, right? So, granted, it's hard to make a deal work right now, but, the value add aspect of it, when you could still buy something that had a lot of potential in it for a decent basis, we could do that. We could go buy a building at $3 million, double the NOI, and it's worth $7, $8, $9 million, right? Things of that sort, because we've changed the clientele, changed the use. This is an even deeper strategy here, and I don't think I've heard this one before. So we've heard of office buildings getting converted to multifamily. By the way, I'm not going to recommend any of you who haven't built at least 10 things from the ground up start that, because that is a heavy infrastructure change to go from office building to residential. Heavy infrastructure. You can really eat your lunch there, but if you know what you're doing, do it. But I'm starting to see other adaptive reuse projects come up, like motels that are failed motels from the pandemic have become short-term living or efficient studio living. You've seen a lot of that happening. So let's focus on this a little bit. And one reason that I love The multifamily space I don't have 5 or 6 leases or even one with an anchor tenant. I have, 200 of them, and they're all typically 12-month leases, or some could be less than that. That's a lot of little income streams. Self-storage is the same way, with a lot less overhead, because you're not dealing with as many people, and honestly, it's a box of air. So first, I want to go into, how do you identify the site, and when I'm thinking about, like what I just said, going from an office building to an apartment building, right? That's a lot of rejigging the internals, upgrading plumbing, electrical, partitions, checking structure. I mean, all the stuff, right? Seems like it's probably a little more straightforward to go and take an already framed out shell that's pretty much an empty department store, for example, and build out what you need. But talk us through the complexities of that, because understanding that is really that's really your basis increase. What do you have to spend to get to that new income stream?
Yeah, I think that's where I want to land with this. If you'll allow me,
take it.
I want to spend two or 3 minutes leading up to that. The way I look at this is, my job is not to sell our deals. My job is to educate. I want to educate on what we're doing and what our projects are. And if they fit in with your goals, that's great. And if they don't, that's fine too. In order to get to that, I want to talk about some of the changes that we're seeing in self-storage right now that I think your listeners really need to know about. And that will help explain why we do what we do and how we do it, with a little bit of background.
Very good.
So there's a massive shift we're seeing in storage right now. Traditionally, you think baby boomers, they're in the property once or twice a year, Christmas decorations, bulky furniture, heirlooms. What we're seeing now, the millennial population is now the largest population segment in the country. They are 34% of the population. They are using 38% of storage. The way they're using it is very different than what we've seen before. Younger people, unfortunately, are not able to buy houses the same way they did before. They're renting. When you buy a house, you've got an attic, a garage, a basement. When you're renting, you're typically renting based upon the square footage that you're getting. So instead of a 2-bedroom condo for $1,800 a month, they'll rent a 1-bedroom for $1,300, and then get a storage unit as an extension of the closet, extension of the garage. They still have stuff, but it's lifestyle things. It's bikes, it's kayaks, snowboards, mountain equipment, waders, fishing rods, that kind of stuff. And they're also storing winter clothes. So because of that, these are expensive, important items that they are accessing a lot more. They're in and out of the property once or twice a month, if not once or twice a week. So that consumer has really changed in that landscape. And because of that, if you are doing storage these days, it needs to be several things: safe, secure, well-lit, easy access, centrally located, and it needs to be climate controlled. They need to be able to show up at 6 a.m. on a Saturday, scan a QR code or use a touchscreen kiosk, get into the building, get their stuff, and head off to the mountains to go snowboarding, right? So that's the shift that we're seeing. It's not just the little metal boxes on the side of the road anymore. Another issue is the cost of construction these days. Self-storage from the ground up is going to cost you $110 to $120 a square foot, plus the cost of the land. Yeah, it's really expensive to build Class A climate controlled.
Okay.
So, a lot of that happened during COVID and things like that.
Is that land basis or is that process driven? I'm sorry.
Both.
Both.
Land basis is the big part of it. Cost of construction materials was way up. Now it's come down some, and there was supply chain issues. It's come down some, but with inflation, it ain't never going back to where it was, right? Even when inflation goes up, when inflation comes down, the cost of goods and services don't. So that's the basis for ground up development right now. It's a lot of risk. It's going to take you 3 to 4 years to go through the entitlement and the permitting process. So that's kind of some education on storage, what we're seeing in the market. Now I'll explain our strategy. We've done everything in the past, from ground up development, expansion, operational turnaround, everything. My partner built his first self-storage in 2006. So it's been a long ride. We started doing conversions in 2016 as individuals, did that joint venture in 2021, started syndication at the end of 2021. We focus on old, nasty, vacant, big box retail buildings. There used to be over 2,000 Kmarts in the country. They are all done. But if you think about that building and that location, it's typically in an area where it's centrally located. It was a large employer for the area, and typically the residential density around there is built in such a way that the people of that community used to drive to that building to buy their home goods. And even though they don't do that anymore, it still makes it a great location for those same people to drive back to the same building and sometimes pay us to put the same stuff right back inside of it. Right? It's an inverse flow of that micro economy. So really good residential density. And what you were talking about is how we pick the building. It comes down to a feasibility study. The residential density in a 1, 3, 5, and 7 mile radius, the amount of storage in the area, what's the price per square foot? Are they full? Is there a wait list? What's the number of people per household? What's the average income, the average age? We know that 11.1% of all households are using storage, not including businesses. There's also a ton of businesses using as a micro distribution point. So they're in and out of the property a lot as well, or companies downsizing, closing offices and things like that. Anytime there's disruption up or down, storage is typically a part of the component somewhere. So we're not going after industrial properties, but like if it's a Kmart and you can smell a McDonald's or a Chick-fil-A, it's probably in a really good location.
That makes sense. Yeah.
These buildings have been empty for 10 to 12 years. It's like flipping a property. You don't make your money when you sell it or when you renovate it. You made your money when it was dirt cheap and smelled like dogs and cats. We want the properties with the hole in the roof with the homeless people living inside. We take that shell, we buy the building for pennies on the dollar compared to the replacement cost, and we'll take a 90 or 100,000 square foot shell, fix the roof, put in LED lights, fix the sprinkler system, and then we're just putting metal boxes and roll-up doors on the inside. Across that portfolio of all the properties I told you before, on the day that we open up and we start renting units at certificate of occupancy, for the cost of the building, the land, the construction, the parking lot, everything, our average is just under $65 a square foot.
Okay.
So half the cost
65 cents on the dollar for, yeah.
Exactly. Yeah. It's typically 110 to 120 for construction plus the cost of the land.
Yeah.
So we're about half the cost of construction with the land included. And from the time we close on the building, it typically takes us 12 to 15 months to open versus the 3 to 4 years for new development. So our model is we move into these small secondary and tertiary markets across the Southeast. Like you won't see us in a Charlotte typically, but you will 15 miles away in a Gastonia, these small towns that are having massive population growth as people are getting pushed out of the urban areas. We go into that town, we snatch up the old soda bottling facility right in the middle of downtown on the main strip. We buy that building. We bought that building for $1.5 million. It appraised for $5 million the day that we closed. By the time we're done and we put a couple million into it, we convert it to climate controlled self-storage. It's going to typically appraise in the 13 to 17 million range, depending on the rates in that market, right? So everyone's different, but that one's like a $15 million project. And here's the key. On average, by the time we fill it up, because of the low cost basis, we're landing at 35 to 38% loan to value, which means we don't have to sell our assets to give everybody a payday. So we offer a preferred return and then cash flow, but at or before 5 years, we will refinance a property from that 35 to 38% loan to value. We refinance to 55, maybe 60%. We always use fixed rate debt, never variable rate debt. We're going to put long-term debt on it there. Make sure we're protecting the asset. It's going to continue to cash flow. Our break-even cash flow point on a property is typically about 40% occupancy. Once we stabilize, we'll do that cash out refi. That gives us plenty of money to pay out all of our investors. We give them a return of capital plus a big chunk on top. That chunk on top, when it's coming by way of refinance, is non-taxable. So obviously the preferred return in the cash flow is taxable. We do the cost segregation study. We take the accelerated depreciation to offset that. Our goal is to do the best we can to try to double everybody's money in 5 years or less. When interest rates were low, that's what we were doing. Right now, it's probably more like a 1.8, 1.9x equity multiplier. But beyond that, beyond the 5-year mark, everybody stays in. Everybody keeps their same percentage of equity, continues to get quarterly cash flow distributions, and it just eventually turns into an infinite return. So we're at 150 million in assets under management right now, and we've never sold anything.
That's a good strategy. And folks, just pay attention to the fact that the key is in the basis, right? The key is in the buy. The key is in finding the property that is well located, fits the strategy, and smells like dogs and cats, as you eloquently put it, or has a hole in the roof that nobody wants, right? The challenge, for example, and I'll say this straight up, we own a lot of apartments in several states and have been doing this for a long time. The challenge right now is, leading up to today, everybody wanted apartments. And so, gosh, to buy that same project, whatever cash flow it was at the time, you had to pay a 4 cap for it. It was stupid, absurd how much you had to pay. And so basically you're working every day just to get your nose back above water if you do that project. So right. This is great. And so give me this detail here. So when you're buying the Kmart, for example, and you've cleaned up the shell's ready to go, new lighting, all that kind of stuff, sprinkler, it's up to code. Redid the parking lot. When you're putting these the storage units inside, are you doing multi-level? Because a lot of times these are high ceilings. Or are you doing single level? I mean, that's a whole different cost basis as well.
Yeah, this is a great question. So yeah, you're talking about mezzanine. So we've done mezzanine on one project before. Okay. We're underwriting one of the projects we're under contract on right now is in Florence, South Carolina. It's got 22-foot ceilings in a large chunk of the building. So it works great as a single level. But right now we're unpacking. The acquisition team is looking at, hey, can this market sustain twice the footprint of storage that we talked about? Yeah. And then we're looking at engineering, and then we're looking at construction, right? So the reality is the timeline would be longer. The capital needed for that project would be longer, but ultimately it would be worth way more. So for us, it kind of comes down to velocity. If we do that on this project, is it worth it? And is it going to slow down projects after that ultimately are not going to help us hit our goal? Our ultimate goal is 500 million in 5 years and $1 billion in 10 in assets under management. And we're on the trajectory for that. So we can do mezzanine. We've done it in the past. We're evaluating right now if we're going to do it. It really comes down to what can the market sustain? Or by dropping that much net rentable square footage into one market, is it going to take a really long time to fill it up? You can't go back and add the mezzanine later. Once you have tenants in there, the insurance is not going to let you come in and make changes and build on top of that. So you either do it up front or you don't. The thing you already alluded to is the great thing is that the basis is already so low that it works great either way. The question is the juice worth the squeeze? There's obviously more risk to the mezzanine component because the construction component is significantly larger. And I'll speak to risk briefly. And you said the smart thing earlier is like, don't go try to convert an office to apartments if you haven't done 10 projects in the past. The reason this strategy works for us and that we have a strategic advantage is that we have full vertical integration. I've got an acquisition team looking at 50 to 70 properties a week, mostly off-market stuff. And we're negotiating deals constantly, 50 to 70 to get down to 2 to 4 we're going to underwrite, to get down to maybe 1 or 2 we're going to send a letter of intent on per month. So out of hundreds of properties. I raise the capital in-house from our private pool of investors. My partners are GCs with 30 years of experience. We build at cost plus 12%. This is all we do. We focus exclusively on conversion projects. And then we have in-house property and asset management. It's 3% property management, 2% asset management for a combined 5%. So my point is, we don't pay retail costs for the building, for the construction, or for the management. That's the reason we land at that 35 to 38% loan to value. We are passing on good projects to get to the great projects that create so much value that we can recapitalize by way of the refinance and keep them. Otherwise, if we're just increasing the value 30, 40%, we have to liquidate. We have to sell the property to pay the investors and everybody to get a payday. And there's going to be some properties we trim from the portfolio as we go along. But the reality is, if you're building up a property, making it nice, and then you have to sell it to get a payday, you're back to trading time for money. That's the cycle that we're trying to break. That's the reason that the name is Nomad Capital. A Nomad is somebody that goes where they want, when they want, and does what they want.
I love it. That's a great mic drop moment right there on the on the strategy and the just the name behind it. Before we end the show, let me ask you a couple of questions, get to know you a little bit better, and then we'll get you back to running the enterprise. All right.
Yep, sounds good.
So first one, Clint, what is your superpower, life or business, your choice, and how does it serve you well?
That's a great question. So I'm an 11 on the extrovert scale.
Yeah,
I love people. I love relationships. No, sorry, I'm coming across so passive. I believe in the power of relationships and people. I'm a good networker, and I like helping people connect with it. If I find people with problems, I like connecting them with people that might potentially have a solution. I'm a firm believer that when it comes to our relationships in our life, that the whole is greater than the sum of its parts. And together we can accomplish big things if we have a group of people that have common core beliefs, values, and ethics. So that's something that I use. I handle investor education and capital raising. So that's something that's allowed me to have a lot of success there, and also having a background of 16 years in the medical industry. Ultimately, I left that in 2022 and just do full-time real estate investing now. But that connection also allows me to speak that language. And a lot of those people have money, but they have no time, and they're looking for a place to put it. So I'd say that just those personal traits that I've tried to use to help us forward, our belief system of what we think the best choice for our lives is.
Yeah, that's fantastic. And yeah, no doubt in my mind, you're an extreme extrovert. So that's great to assert here. Let's go to the other side of the coin here a little bit. And I mean, let's talk about your biggest failure or just general mistake. Most importantly, what did you learn from it? And again, could be life or business, man.
A lot of times the biggest mistake that I've made as I built out a single family portfolio, then a small multifamily portfolio, then a property management company is not having a big enough vision and challenging myself to have these really
Yeah.
goals that are borderline crazy. And also along with it, having now the vision of being like, I'm dropping the word $1 billion in assets under management in conversation. And that was a hard thing to do at first. It sounds comical, but the reality is I see our trajectory. And I also took the lessons from Who Not How. In the book we talked about better is like, I have the ability to have vision. I need to challenge myself on that vision. That's not something I'm great at. And I need to compensate for my inadequacies as an operator by partnering with the right people that have skill sets that we can lean on them as the bedrock of the operation. And I can help broaden the vision of among a team of people that believe in what we're trying to do and what we're trying to accomplish. My partner, Eric Hemingway, quick stories, when the market, he built his first storage in 06. When the market crashed in 08 and no one was building anything, he and his wife, Rachel, and their 5 kids bought a 36-foot catamaran in Greece, sight unseen, and sailed for 3.5 years, had a 6th kid in Jerusalem while they were sailing, sailed back across the ocean, landed in Wilmington, and started building again. He has an unbelievable tolerance for risk that also comes with an unbelievable gut for a good deal. And one of the things I've had to learn from him is that risk is a muscle. First of all, there's a difference in risk and calculated risk, but risk is a muscle. And the more that you're willing to work that muscle, the stronger it gets. And that's what you have to get continuity with those big, scary goals that you're willing to set for your life.
I have never heard it put that way, but I'm going to write that one down. So I taught you something, you taught me something. Risk is a muscle. I love that. Okay, very good, Clint. Last 2 questions. Talk about philanthropy for a second. So that's one of our 4 pillars here at Quattro: people, property, profit, philanthropy, coming back and taking care of people. I love to give my guests an opportunity just to talk about your philanthropic heart, where your giving heart lies, time, talents, treasures. You never know. Sometimes we've actually gotten reports of people giving on your behalf as well, too, if it's to like a public charity. But what is that for you?
Yeah, I love that you're bringing that up. So I have a lot of thoughts on this. I'm not taking as much action right now as I hope to be in the next year because I've got a 1-year-old and life is tough right now. But I believe in the importance of being a part of local community and giving to your local church. Outside of that, I think that there's also opportunity to do bigger and better things. My partners are partnered with Amigos for Christ and go down and put, water pumps and wells in Nicaragua. And they're doing these things that involve travel and exposure. And one thing that's really important to me, I live on an island. It's not the most expensive beach in the world, but there's a lot of nice houses. There's a lot of wealthy people. I have a 4-year-old and a 1-year-old, and I am concerned about raising little turds that are surrounded by money and privilege and people that are only focused on those things. So my interest, my wife and our interest is in starting a family foundation. As we exit some of these deals, there's going to be opportunities for us to make some large charitable donations. And I would like to do that into a family foundation that creates a purpose for our life and our family that my boys can be involved in, that involves travel to other cultures to see different people. Because honestly, like I don't want them to be raised in this bubble that we're in. I believe that travel to other places and giving to other people creates empathy and a sense of gratitude, right? So it's always about what you can do for other people, but inevitably it has an effect on you. We're not in the position right now where we can travel and we can do charity work right now because we've got a very young one, and it's trying to travel with him is a nightmare from personal experience recently. But I want to get to the point where we're not just doing charitable giving. We're doing charitable giving that has the ability to change the character of my kids and affect the way that they have a relationship with their kids. And that has potential to affect generations long after I'm gone. And so we want to build a foundation and come up with the causes that are important to our family and have that be a big, important part of who we are.
That is so well said. And I'll say this publicly for everyone to hear as well. If anyone else is having similar thoughts like that of starting a family foundation, you can go start a foundation yourself and run all the compliance and do things like that. We run ours, and as do a lot of people that we know who are very big names you'd recognize, through the National Christian Foundation, something called a donor advised fund or an impact fund. And if you're big enough, a supporting organization. But think about having the foundation compliance and staff and accounting and legal, and even access to, hey, help me develop a giving strategy, with here's what I want to do. Who are the players, right? That kind of support is out there for those of you who want to be generous. So that's National Christian Foundation. I think it's just ncf.com or something like that. But anyway, had to recommend that. So last question for
you taught me two things today.
Go ahead.
I didn't know that. You taught me two things today.
I'm telling you, we went to start our own foundation and we got overwhelmed with like, okay, here's the staff we have to have, here's the compliance, and then a wealthy friend of mine told me about NCF. And anyway, so check it out.
That's awesome. Thank you.
And anyone drop a comment if you need a connection there. I'm happy to do that, but they typically have regional offices all over the country. So second to last question. I believe, looking at your questionnaire here, you have a free gift for the audience or a podcast or something of that sort to share.
Yeah, so our podcast is, I co-host the Truly Passive Income podcast. It's an educational platform. Again, I'm not trying to sell anything there, but it's a way that I educate myself. I find 50 of the smartest people a year that I can find and bring them on so that I can educate myself and get better at our strategy and do a better job of taking care of our investors. So it's a different platform to just be a resource in this space and help people connect and get better, right? So yeah. Truly Passive Income is the name of our podcast. I got my co-host Neil. He's great. I'm not that great at it, but I'm trying to get better. So happy to have people pop over there and check us out.
Somehow I highly doubt that. But yeah, we are absolutely doing the same thing here. This is a great way to learn, great way to have conversations. And just by listening to Clint talk today, I think you will enjoy his show, given that he is an innovative thinker and they're doing an outside the box strategy in and of themselves. So check it out. It'll be in the show notes for your clicking pleasure if you're driving or something like that, but check out the show. And hardest question of the day. You ready? Then we're going to close the show. How do people get in contact with you should they choose to do so?
You actually had me, I was like, man, he's asking some great questions. This was good. The best way is you can connect with me. Anybody can email me, clint@nomadcapital.us. Our website is nomadcapital.us. I'm on the Truly Passive Income podcast and also on LinkedIn and Facebook. It's Clint Harris with Nomad Capital. Happy to talk with anybody about anything. Like I said, I'm a big networker. So if there's anything that you think I might be able to help with or question that I may not know the answer, but I can probably point you to someone who would.
That's amazing, Clint. Thank you for coming on the show, sharing a wealth of knowledge, the stories, the lessons, and the strategy. And hope to have you back on soon and maybe reciprocate.
That sounds great. Thanks, man. I enjoyed the time.
All right, everyone. This has been another episode of the Real Estate Runway podcast. Until next time, over and out. Remember, like, share, subscribe, pay it forward. See you next time.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com and scroll down for more info. Until next time, this is the Real Estate Runway podcast.